A storm is brewing in global financial markets as a global currency crisis has started, and the risks are high because one false move at this point could send the entire global economy into a depression. But what's really driving this crisis? Well, the truth will change the way you see the economy and central bankers. I'm your host, Steve Van Metre, and thanks for joining me today. Our show today starts out with none other than Fed Chair Jerome Powell, who did something completely unexpected this week by cutting rates. He came out and said, based on the Fed's projections, that the U.S. economy was likely to expand next year and inflation would head higher. And in response, the board voted to cut rates and then said they're likely to cut rates twice next year. And the media responded immediately during the press conference questioning the Fed's decision. And Powell said, well, based on their data, they believe the funds rate is still restrictive and that they need to keep further cuts on the table to keep the U.S. economy running. But the real truth is, Fed Chair Powell knows we're in the beginning stages of a currency crisis and the Fed is at the epicenter. And if one false move sends the global economy into depression, well, you can only imagine with President-elect Donald Trump taking office in January could be the end to Fed Chair Powell's term and perhaps the end to the Fed altogether. And here's a question I have for you. Will Fed Chair Jerome Powell prevent a global currency crisis? Check out the description below. Hit that first link. I want to know, do you have faith in his ability to manage the U.S. financial system? Or do you think perhaps not a chance, there's nothing he can do, and that I'm just making a joke? Because the dollar rises to the highest level now since 2022. Less Fed cuts are seen in the horizon. And the issue here is all about the dollar. We've talked about this before, that it's okay over time to see the dollar rise, but over long periods of time, the dollar needs to steadily decline. But when you see it rise, is it in terms of just seeing speculators entering the market, or is it a sign that financial conditions are tightening? Because if it's a sign that financial conditions are tightening, and we can see that evidence all across the world, well, what it means is we're about to kick off a massive global currency crisis. And one of the reasons this is so serious is because countries all around the world, they borrow in dollars, and people in those countries borrow in dollars. The issue here, as the dollar goes higher and their currencies plunge, well, it means the cost to service that debt goes up. The risk that they could default on that debt goes to the moon. And that's a huge problem. We've seen this happen in the past before. It was outright disastrous for the global economy and for global markets. Because one thing everyone believes is that the Fed has power over the dollar. And it's simple. We'll take a look at this chart here and we see the federal funds rate against the nominal broad dollar US index. That's shown in red. And the belief is that when the Fed tightens monetary policy by raising rates and doing something called quantitative tightening, that the dollar goes up in value. And when the Fed eases by cutting rates and doing quantitative easing, but we think is coming back in the near term, that the dollar goes down in value. But yet, there's really no evidence any of that is true. In fact, the central bankers have no power over the currency. They just don't want you to know it. And the evidence is very clear here. We see going back to around 2007, the Fed starts cutting the funds rate, but the dollar was already in a decline. Now, market participants will simply tell you, well, the dollar was anticipating the Fed's cuts, but you'll see here around 2009, the Fed's still cutting and the dollar shoots higher before it resumes its downward trend that, again, many people would say has everything to do with the fact that the Fed kept rates at zero. But you have to ignore what happens following from 2012 all the way to 2018, because what happened is the Fed keeps rates at zero to 2016, and the dollar is headed higher before the Fed even starts to raise rates. But look what happens around 2019. The Fed starts to cut rates again, and the dollar goes higher. Well, not a lot higher, but still maintains its upward trajectory. And here we have the Fed cutting rates once again. The dollar's going up. There's an issue here because the reality is there isn't any evidence the Fed has control over the dollar. And that's one thing we now understand very clearly is the reason Chair Jerome Powell decided to cut rates and said they need to cut rates next year is not because the U.S. economy is going to expand. That would be an ideal scenario to see the U.S. economy continue to grow. It's all because right now global currencies are plunging. They're all connected to the dollar, and the dollar is not responding to monetary policy. This is a very serious issue. Every detail of the Fed was undeniably hawkish. All this means is a sharply stronger dollar as it continues to amplify U.S. growth exceptionalism. And that's absolutely furthest thing from the truth, because that's not how the dollar works as a global reserve currency. You see, dollars are created through trade by commercial banks, and that's where we see the bulk of dollars actually entering the system. So when the global economy is expanding and trade is growing, you see dollars entering the system through the banking system, and next thing you know, they're expanding, and as a result, the dollar actually loses value. And over very long periods of time, a reserve currency should lose value. So the notion here that you're seeing an expert suggest that U.S. exceptionalism is leading to a stronger dollar, what we're actually seeing now is not just speculators driving the dollar higher. What we're actually seeing is financial conditions are tightening. If they get too much tighter, it's going to break the entire global financial system. And there's some evidence about the dollar and its relationship to the commercial banking system. As we take a look at commercial industrial loans here in the U.S., this shown in blue on a year-over-year rate of change against the nominal broad U.S. dollar index, still in red. And here you can see going back to 2008 and 9, you see a deceleration in commercial industrial lending, and the dollar starts to head up. Not only is it going to the financial crisis as a safety trade, but as the system is creating fewer and fewer dollars. And that's the real issue here, because when the blue line hits across the horizontal black line, it's in contraction, meaning the financial system's destroying dollars. So you see the dollar peaked, it cooled off a bit, but still remained elevated above its prior downward trend. Then what happened? The financial system started to bottom out and turn around. What did we see? Dollars started to be created by the financial system, and next thing you know, the dollar comes down in value. But what happens around 2013? The banking system slows down, the dollar goes up. You see that happen once again around 2016. A slowdown in loans leads to a rising dollar. Again around 2019. And now the dollar's headed higher, and when we look at commercial industrial lending, it's virtually zero. It's not seeing any growth on a year-over-year rate of change, which is implying that lower interest rates are having no impact here. So the real issue is there's a massive amount of debt in the system, not just in the U.S., but outside the U.S. that's in dollars. And the issue here is there isn't enough new money being created to pay on all of it, which is causing financial conditions to tighten, causing the dollar to head higher. Those who have dollar-denominated debt, is costing them more to service it, and that means they're being forced to sell more of their local currency on the market, driving it down in value, and all that's going to do is break the back of central bankers. And here we can look at the funds rate against commercial industrial lending. You can see there's virtually no relationship. As commercial industrial lending typically slows down, the Fed does cut rates, but you'll notice it virtually does nothing. The Fed keeps cutting, and it's not about the Fed. It's all about the economy in terms of when it's ready to turn around. And yet we see that everyone believes that lower interest rates are the key here, but reality is lower interest rates absolutely have no impact on lending until they've been cut substantially. But something that should have a huge impact on your portfolio after the last 2 days have melted down, that would be agricultural commodities. We've shown this to our subscribers back on October 31st, and if you're looking for a way to hedge your portfolio or get an edge in trading, well, we had it for you. And as of yesterday, that trade was up nearly 7%, and it's going back up today. And you could have completely hedged your portfolio. You could have hedged your trading account, all because we look at machine positioning and momentum every day. We have 2 reports, and this one showed up on the same day, and we actually give you in our notes that come with all of our reports my view on what I think of the trade. Here you can see I like to set up buy it at open, and sure enough, that trade has saved a lot of our subscribers' accounts. Now, whether you want to trade against the machines or trade momentum, you get the daily reports, the signals, my opinions on those trades. We fully back tested all the reports. We give you risk control levels. We track all the trades and returns. I disclose my personal trading account to you, and we give you a weekly update. But here's the thing, on December 31st at midnight, the 30-day free trial was going away. So if you've been thinking about trading or you want to do a better job on trading, grab those links before they're gone, because let's talk about the disaster that's about to hit the global currency market. And you can see it's happening right now. Let's take a look at some of these headlines. As Brazil's central bank burns 17 billion in reserves to list the real. Now you think about this, what's going to happen when central bankers all around the world burn through their reserves. Well, that means they're going to have to come to the Fed and do currency swaps. And at some point, the Fed's going to have to aggressively cut rates. They're going to have to go back to quantitative easing. And yet the Fed did something very peculiar this week. They did something to the reserve ratio. Now, we talked about this the other day, and I want you to reframe this in terms of the fact that Fed Chair Powell is very aware there's a currency crisis, but there's a huge problem. He's only limited to the data in terms of what he can do, and what he said is inflation's a problem. At the same time, he's cutting rates. But what is he really trying to do? He's looking for every possible reason to get the funds rate down, to weaken the dollar, to keep the global economy from imploding. And look, it's spreading up to Canada as Canada's dollar slumps to COVID-era low on political turmoil, but it also has to do with the fact that the loonie has lost over 7% against the U.S. dollar this year so far, which is going to mean that the Canadian central bank's going to have to intervene. But we then turn to China, who is actively intervening in the market as the PBOC offers the strongest yuan support since July after dollar gains. And this is, again, it's all about the dollar, because if you think about this, what if the dollar was plunging in value? Would you want to hold it? Well, of course you wouldn't. What would you do? Well, you might turn it into cryptocurrency, into gold, silver, hard assets, perhaps some other fiat currency. You do anything to get your money out of that system because it's losing value. So you look to Canada, you look to China, you start looking around the world, and what are you seeing? These currencies are plunging in value, meaning people are looking for a safety trade. What is that? It's the dollar, which is sending itself higher. So you see the risk here. We look around the world, and these foreign central banks need to stop the decline of their currency. At the same time, the Fed needs to stop the appreciation of the dollar. And look at this. You see that happening in real time as China's overseas investment adds to cash exodus, weighing on the yuan. So people want their money out of China. And in general, they want it out to begin with. But as the yuan weakens, they want it out even more. And this is a problem because as money leaves China's system, well, it means their economy is about to crash. Now, we already know it's headed into recession. What this means is now China's economy is facing a depression. Brazil's economy facing a depression. You see the risks here are outrageous. But look further. Billions of dollars, bold action needed as emerging countries battle a surging greenback, now facing the worst quarter in 2 years for the MSCI EM currency index, as intervention can only slow currency depreciation. And that's the point. It can only do so much. And what happens when they run out of the ability to stop it? It means the dollar is going to shoot higher, those currencies are going to shoot lower, and it's going to break financial systems all around the world. Authorities said in developing economies are on the defensive with the greenback strength wreaks havoc across the global markets, with South Korea's won falling to the lowest in over 15 years, while India's rupee and the real crashed to all-time lows. A rapid decline in currencies risks worsening the impact of imported inflation for emerging markets and may also increase the cost of servicing debt on foreign liabilities. So you see two factors here. One, inflation is not going to be an issue for the U.S. if the dollar keeps going higher. There's also a secondary factor. Exports are going to get hit. The U.S. job market's going to get hit, but inflation is going to show up in these other countries, meaning their central banks are going to need to tighten monetary policy because, again, everybody thinks central banks have control over inflation. The problem is, if they tighten monetary policy, they're going to drive their economies into recession. They actually need to ease here, but they can't ease because they're afraid it would drive their currencies down even more. But again, it's all about these foreign dollar-denominated loans that are going to be facing massive delinquencies and defaults. But the pushback against a stronger dollar comes at a cost, with monetary authorities forced to dip into their foreign exchange reserves to defend their currencies. The question is, what happens when they run out? Well, we do know to some effect they'll come to the Fed. The Fed will open up swap lines. A crisis will hit. But that's why I want you to understand, we talked about what the Fed did this week, and not cutting rates. It was what they did to the repo market. I want you to understand this move was specifically designed to set the Fed up to cut rates in the future. The problem is it's going to have the exact opposite effect that Powell wants it to have. Now, it will lead to them cutting rates, but in the short term, it's going to make things worse. As the repo benchmarks drop, as the Fed tweak aims to keep volatility at bay, as we see the short-term rates in terms of the SOFR fixed at 4.3, down from 4.57%, as the officials lower the offering rate on reverse repo to 4.25%. Now, what the intention here was to get roughly 123 billion of US dollars out of the repo system and back into the economy. The idea here, you think about this from Fed Chair Powell's perspective. Hey, you've got a bunch of money locked up at the Fed, the world's short dollars, get it out of the system. The problem is it's not the right answer. That money coming out of the Fed system is just going to fight for short-term treasuries and drive interest rates down. Now, you remember yesterday I said, look, this is the exact move the Fed wants. They need an excuse to lower rates. And sure enough, look what's happened since yesterday. 6-month bill yields shown in red have continued to go down against the federal funds rate, setting up not just 2 cuts for next year, but likely a cut early next year, possibly even in January, and more cuts to follow. So by doing this, Powell on one hand is driving short-term rates down so he can come back and say early next year, well, you know what, we weren't going to cut, but financial conditions are tightening because we see the interest rates are going down. Now, he's not going to tell you that, because if he simply told the media that, hey, we follow 6-month bill yields, well, the reason we even need the Fed kind of goes away. But he's going to say that financial conditions are still too tight and that policy is restrictive and they need to cut rates. But he's doing it not because of what 6-month bill yields are just specifically telling him. He needs to do it to starve off a currency crisis. Now, the smart move would to bring money into the repo and leave cash into the financial system. That's the issue here. He's pulling money out of repo into the system, and that money is going to get tied up in T-bills and not go to help anybody else. You start to get why we're very close to a massive cutting cycle and quantitative easing, because it's going to hit U.S. exports. When the dollar goes up, as we look at the nominal broad dollar index still in red, against exports of goods and services coming out of the U.S. on a year-over-year rate of change, what do you see? Dollar goes up, exports go down. You see it happen again in 2014 all the way through 2016, and again starting in late 2018. Now, you can only imagine what President-elect Donald Trump's going to think if exports start crashing because of the dollar. Now, we already know he wants to see the dollar weaken. Whose job is that? Well, it comes all the way back to Fed Chair Jerome Powell and the board. You can see why this is going to be disastrous for the U.S. economy if the Fed chief doesn't get this in control, because if exports go down at a time when U.S. manufacturing is already slowing down, what is it going to lead to? More Americans out of work. Inflation isn't going to be the issue next year. Growth isn't going to happen either. The problem is, what are we going to do to get out of a recession and potentially a global depression? Because the Fed's favorite inflation gave cools to the slowest pace since May. So the issue now then turns to today's data, where the Fed finds out, wait a minute, we can't cut because inflation's going up. And we just told everybody that we're focused on inflation and we think the labor market's not going to get any worse. But yet, if the dollar goes up, the labor market is going to get worse. So the Fed now hamstrung themselves based on the data to say we can't cut. But what they can turn around and say is, yes, we see that policy is restrictive, and they can tell that right exactly what the T-bill market is telling them. The so-called core personal consumption expenditures price index, which excludes food and energy, increased 0.1% from October. So we're seeing a slowdown on month to month, but on a year-over-year, it rose to 2.8%. The monthly advance was the slowest since May, indicating that we possibly could be at the beginning of a downturn in inflation. Of course, 1 month doesn't change everything, but it does give us some possible indication. The data marks one of the first reports indicating renewed progress on inflation after stalling in recent months. That's prompted the Fed officials to update forecasts earlier this week, showing a higher path for prices and interest rates in 2025, which helped trigger a broad market sell-off. Well, that was the excuse, of course, as that was caused a market sell-off. The reality here is the Fed claims they're data dependent, so they have to be. But if Powell can drive T-bill rates down by clearing out the reverse repo, he can go on and say that policy is too tight. It's all about the bond market in that case. And you can see that if yields go down, inflation does go down. As we take a look at 6-month bill yields shown in red against personal consumption expenditures, that's shown in blue on a year-over-year rate of change. So while the Fed says, hey, we think inflation's coming back, we're concerned about that. Well, if you drive interest rates down, you can see the clear relationship. When the red line goes down, inflation goes down with it. And spending continues to be supported by solid earnings as wages and salaries grew by 0.6% in November, the most since March. However, overall disposable income rose just 0.3%, restrained by declines in dividend income and government benefits. But the reality is those who have jobs are the ones who are getting the raises. The reason we're seeing incomes rising is because more Americans are hitting the unemployment line. And if the dollar surges, we're going to see a rash of unemployment here in the U.S. and all around the world. We're going to potentially watch governments topple as financial systems completely implode. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.